Hey, good morning, everyone. Chris Lopez here. I want to welcome you to today's webinar. We're going to do a deep dive into the Northern Colorado real estate investing market. Our goal here in about the next 45 minutes is to give you a detailed guide for the trends, what's going on in Northern Colorado. We're going to cover 3 deal analyses and also talk about some opportunities in the current marketplace. But of course, before getting the details, I have to go through the standard disclaimer here. We are not giving you legal, accounting, tax, or financial advice. Please consult your professional team. And I've got 2 great co-hosts with me here. The first is Mr. Newt Wyler. Newt, how are you?
I'm well. Thank you, Chris.
So Newt is our lead agent up there in Division Advisors. He runs the Northern Colorado market. He's also the managing broker for your castle up there. So he has tons of experience, knows the market, and also knows how to build teams up there. So Newt, glad to have you on the webinar.
Yeah, thank you, Chris.
And our second co-host is Steve Medina. Steve is an investor turned realtor who also lives up north as well. And Steve is just chock full of analyses and trends. And if you want to understand what's going on, Steve is a guy to tell you and help you actually understand it, to boil it down to how to make it work for your situation, your portfolio. Steve, I'm glad to have you on the webinar and the team.
Awesome. Glad to be here.
So we're going to go through all this. If you guys have any questions while we are talking about, drop in the chat box, or if you're watching the recording, reach out to ideally Newt or Steve, because they are the Northern Colorado experts. You can reach out to me and I'll probably loop them in here, but we want questions live or after the recording. And we are going to go through a lot of data and slides as well on here. So if you want to see all the details, follow the link in the show notes. You can download the slide deck and we'll have all this stuff, all this on the website very soon as well. So before we get into details of the market trends and what strategies are working on there, I want to take a quick step back and talk about our 3-factor alignment. This is a framework we use to help people understand what's the right fit for them, or as the slide says, the sweet spot. And it's really, where can we find that overlapping sweet spot between what are your goals, your risk tolerance, with what strategies work in the marketplace and that you also want to execute, and then do they work in the market? So as we go through this webinar, we're going to be really talking about the market and the strategy sections on there. The goals are obviously very, very personal, and everyone out there has their own goals. So this is why we always offer a free consultation here at the Envision Advisors. And if you're a new investor, that is a strategy call to help you kind of figure out how to get into investing, or if you're new to the market. We also have a lot of people with rental properties out there and already have a current portfolio. If you have that, great. We'll do a blend of a strategy call and also review your portfolio with our tool Property Law to help you understand what opportunities you have and actually map out how to get to your goals. So reach out to us, or you can scan the QR code as well. And the great thing about this, now Envision Advisors is officially Northern Colorado. Newt came aboard about 5 months ago, I think.
Back in February, March.
Yeah, feels like it's longer than it's been, but it's been a great thing. Steve just came on recently, and we have a dynamic duo of knowledge, strategy, agent up there to go out there and help you guys figure out if Northern Colorado is the right fit for you and how to make it work for your portfolio. So now we're going to jump into the fun stuff about Northern Colorado, and we are going to start with some market data. So Steve, give us the executive summary on Northern Colorado. Like, interest rates are high. What do we do?
Yeah, well, you know what? We take what we are given. So we need to understand what the market looks like, what the long-term play, what the short-term play is, and how those blend together. So that's what we do. So right now, with high interest rate environment, we've got an opportunity to buy equity, because there's 2 people selling, 2 different kinds of sellers right now. Those that need to sell because they have some reason, and then new home construction. Some of the other strategies that are working are house hacking, because you can get in low down and then you can refinance later. And then there's some new construction out there that's got some amazing deals, because they're trying to offset some of the cost that are happening because of higher interest rates. So those are really good things that are out there right now. So some of the things that are even more positive about Northern Colorado, it's got the fastest growth in Colorado. So we've got 2 counties that are 51% of the growth out of 64 total counties in Colorado. So that's a big deal. You've got a ton of jobs coming up there, and you've got a ton of big investments that are coming in up there. So those things make a really good opportunity in northern Colorado. And so that's where we're seeing some of the things, and that's what we're going to talk a lot about today.
Yeah, and you got the most important things: job growth, population growth, and I definitely someone that's Denver based, I definitely see northern Colorado as a huge opportunity for new construction, which is often on the easier side of buying rentals since they come with warranties and have less stuff breaking usually. But the high level, you said buying now is buying equity.
That's right. So just some of the overriding kind of macro, issues is that interest rates are, limiting sellers from, getting into the market and putting it on market. It's a barrier for investors that are seeking cash flow. Renters can't get in, so they're stuck in the rent space, and then there's still too few houses available. So those things are kind of macroeconomic, but they also play into how we factor the opportunities in northern Colorado. So
okay.
And then some of the opportunity costs I think are important to look at too, because we don't always look at those. If we use our forward long-term vision and we see that rates will come down at some point, they won't stay artificially high forever. That means that when they start to get down, people are going to take that pent-up demand and start to chase properties again, and that's going to drive appreciation. So not sure quite how they're talking about easing it, but that will be a real factor. So when we get back to a fairly normal, balanced market, that's going to be a factor that you don't want to deal with if you can deal with it today.
Yeah, very well said. And just some quick stats here, because I've been amazed at the growth NOCO has.
Yeah. With the detached housing, it's growing at a rate that's double what Denver is. And so that's pretty straightforward, but it's nice to see kind of the appreciation going up there. When you get to the attached housing, it's actually growing at over six times what kind of the Denver markets are. So we've got strong appreciation still up there. It's not everywhere, but it's where to find it that it's going to continue. So.
Yeah, and actually this was like, I'm looking at detached homes here, like last year, you guys appreciated about 6%, and Denver was just under 3%. And I did not know until we put this data together that you guys had that strong of appreciation up there.
Yeah, there's some really good spots up there. Now, when you look at it kind of in totality, it doesn't always paint the correct picture, but when you start looking inside some of the smaller markets, you start to see where the opportunities are, and that's what Newt and I do all the time. Yeah. So,
and for those listening to the podcast or listening to this, we have a lot of data and slides. So check out the YouTube video or check out the blog post, and all these slides will be on there so you can either see it or actually dig into all the data. But we won't put you to sleep with walking through every single chart on here.
This is, just to show that over the last 13 years, the big five, they call them Loveland, Longmont, Boulder, Fort Collins, and Greeley. And they've been growing at about, over 9% appreciation. So we can't count on that, but just to show historically what's been happening up there.
Is a lot of that weighted by Boulder?
Boulder to some degree. Boulder's starting to flatten out a bit now, as we've seen. So, we're seeing some of the otother markets come in. So you're seeing some of these smaller markets that are
the more affordable markets.
Yeah, where they have, where it's fresh real estate that they can put on, and so there's a lot of people that are gobbling those up.
Yeah. Do you guys have any favorite markets right now?
Windsor's very popular right now.
Yeah.
Yeah, I honestly feel like I stumbled into that one, and it's been a great place to be. So it's like,
is that where you're at now?
Mm-hmm.
Okay. Mm-hmm. And then you're
I'm in Loveland,
right? Okay.
But, also, Greeley is primed for growth.
Yeah.
I mean, there's still plenty of space out there to build and to find those investment opportunities that we've talked about.
Great. Well, I love that we have real experts up there now. All right, let's talk about the growth drivers, because I've always I'm a keep it simple, stupid person, guys, as you probably know. And it's just like, hey, you can analyze all sorts of data and 1,001 variables. And with most things, 1 or 2 or 3 things really matter. And I think growth is it.
Yeah, growth really is it, but there's some other contributing factors that are helping. So when you think about markets, if you just look, there's a certain brands are a bundle of perceptions. So when we think about Denver, we think about certain things. When we think about Fort Collins, we think certain things. When you think about Greeley, Pueblo, Colorado Springs, you get a certain feel out there. And so what we're seeing with Northern Colorado, it's got a lot of positive momentum from people that are coming up. There's tons of things to do outdoors. You can be stand up paddle from 5 minutes from your house. You can do all kinds of bike riding and other activities that get you outdoors. So you have all these great outdoor amenities, but you also have the city amenities that are growing up there too. Yeah. So, and that's why I think some of the space that's available up there, some of the economic environment is what is creating an opportunity for more jobs to come in there, more investment to come up there, and the people are coming up there too. So we're going to see, I think the forecast is pretty phenomenal for those two. So we'll get to that in a minute now.
Yeah, I love how you describe like having the market as a brand. Obviously, I've talked about brand. I know thought about having like the markets have a brand. So I like that concept a lot. And you're right. Every city has a different brand or feel to it.
You think about Detroit, you get a certain set of perceptions, right? You think about, Windsor now, and you start to see it. You go, oh my gosh, that's a different place.
Yeah. How long you guys lived in Northern Colorado for?
I've been there for nearly 30 years now.
Okay. So you've seen lots of change.
I have. I've seen it grow tremendously. It's grown huge compared to when I moved there in 94.
Yeah, I bet.
Yeah, I've been up there, 2.5 years? And so we were down in Arvada before that.
Yeah.
So we were in the area, and we'd go up there to visit baseball tournaments, do outdoor stuff. But now it's like, it's a little more slow pace of life. It won't be that way forever because it's going to get caught up, but it's a great place. I like it because there's a lot more small town kind of feel to, just not as much traffic.
And lots of space.
Yeah, lots of space. So. So, this is just more to show there's some really big, employers up there, and Northern Colorado has, been continuing to have lower unemployment rates than the rest of the state, and the state has lower unemployment rates than the rest of the U.S. So they're still in a really good spot. So there's some amazing information out there about how they're trying to pull in more, job ready and prepared, young students and young employee, storage, not storage, but what do you call them? Like, they need more staff. They need employees. And so that's going to be a one-to-one relationship over time. They can't grow their businesses without good quality employees. And so that's what they're starting to see in some of the high schools and things like that, is they're creating more opportunity for employers to have good employees right out of high school, right out of college.
Oh, fantastic.
And these are some of them. You guys may know some of these. Who knew that we had Ursa Major is rocket engines out of Berthoud. And some of these others, Vestas, Agilent, Microvast is one of the country's leading, lithium ion battery manufacturers.
Oh, okay.
So they're up there. There's rail up there. There's all kinds of things up there. So some of these, higher tech or higher paying jobs.
This is my favorite one, the population growth. If I could pick one statistic to look at and make a decision on, it'd be population growth.
Well, and this one's kind of caught me by surprise too, because I could see the growth going, but when I started digging into the numbers, it was like, wow, out of 64 counties, 2 provide over half of the growth. And there's about 366,000 in Larimer and 350 in Weld. Those are projected for Larimer to go to about 500,000 by 2040. And Weld is supposed to be close to 600. So it's going to grow 250,000 and 150,000. So you're talking 400,000 new residents up there. Where are they going to live? Where are they going to work? Where are they going to do all that stuff? That's what they have to solve for the next few years. So there is a great mix of housing products up there.
Yeah, I was amazed. I mean, you have Larimore was 15% of overall Colorado growth. Weld was 36%. So those 2 counties are doing just over 50% of the population growth, which is bonkers. Like, I knew you guys were growing up there. I didn't know it was like that, though.
Yeah, don't tell anybody. Oh, no.
Yeah.
Well, I don't think it's that. Because I think the first thing when Newt walked in the door was you had a couple colorful things about the traffic up there.
Yeah.
Well, there you go. You want to get rich in real estate, you got to deal with some traffic, right?
That's true. Yeah, I'm tired of slamming on my brakes.
All right. And yeah, talk to us about new construction, new investments, because like one of the brand associations have with Northern Colorado is new.
Right. And that's what it's kind of fascinating when you boil it down. New is really what's driving the markets right now. You're seeing new construction and new investments. And so we're seeing things, and you guys, may have seen them out there, but there's things where Centerra South, the McWinneys, are trying to build $1 billion multi-retail, multi-family townhomes and things like that. That's just one project. And so they're building out a lot of things up there that are going to continue to grow. There's, for you guys that don't know, is Burlington Northern Santa Fe is looking at an intermodal one facility they're putting in Hudson. And it's projected to hire between 10 and 20,000 employees, because that's just massive. It's like billions of dollars into the economy. The Rodeo Dunes, somewhat similar to like Bandon Dunes in Oregon, they're putting in a brand new set of golf courses. They got 2,000 acres where they can build 6 different golf courses to make it a destination resort.
Oh, wow.
Yeah. And they're just smaller, but people love Buc-ee's. It's kind of that visible signal. The world's biggest Buc-ee's was, I think, slated for Tennessee. And the only difference is it's got 4 more pumps than the one we're going to have in Johnstown by the end of the year.
It's coming up quick.
Yeah, this is actually probably my thing I'm most interested to go see, because I've heard it's basically a Costco at a gas station.
Apparently their barbecue's amazing.
I want to go experience
You can get anything on any shelf in there, so help yourself. It's a thing.
And they serve gas.
Yeah. 117 pumps.
When we do a bus tour up there to go look at properties, it'll be Buc-ee's, right?
There you go. Yeah.
We'll be stopping at Buc-ee's and Newt's Bar.
That's right. We'll go over to Greeley.
Well, and across the street from Buc-ee's is a whole new retail section coming out. And then there's the Revere development that's about 1,500 houses. They haven't punched holes in the ground yet. So there's a whole sequence of things that's coming up there, and they're investing. They need employees. People are coming. Weld County is a little bit younger than Larimer County. And so there's a lot of, organic population growth, because it's a younger community. They're having more kids. Well, guess what? They're growing out of the houses they're in. They're going to need to move. So it can't survive in a static market. It's got to grow. And that's why we're kind of seeing the new normal now. But when the rates get back to being not artificially raised, things are going to really start to ramp up. And that's what we're excited about seeing.
Yeah, so love that. And then this moves us into the strategy. So great job, guys, when covering the market data, because I gave you guys a very hard job. I said, give the couple of key points of market data that tell the story. 2 thumbs up. There's a lot more data that we can share, a lot more data that we have access to. If you guys want more data, reach out to us. We've got, slide decks and reams of a lot more data up there. So if you want more of it, reach out. But we want to give you the high level of job growth, population growth, new construction, new investment. Those are the themes. There's growth and new. Mm-hmm. And now we want to kind of shift to our third circle, which is now the strategy circle. And that's saying, hey, what type of real estate investing strategies work in the market right now? Because depending on the market and depending on overall market conditions, different strategies work, and some are harder, some are easier. And we're always trying to find out, hey, here's kind of where we see opportunity, and I want to present that to you. So one thing that you pointed out, and I love this term you used, Steve, was you called it a false seller's market to kind of like set the stage. What is a false seller's market?
Well, as we look at supply of real estate, kind of the number of units that are actually available at any time. If it's under 4 months, we generally consider that a seller's market. If it goes 4 to 6 months, we're starting to be in that balanced market. If it's above that, it's a buyer's market. But there's something else that's going on right now that isn't always obvious to people. There's an artificial play happening on interest rates. So what that's doing is it's causing sellers not to want to put their properties on the market because they may not get the value they're seeking for them. And so that's creating what we would normally look at first glance and seeing seller's market. It's actually a buyer's market out there. So that's what's fascinating about the false seller's market.
Yeah, this is where months of inventory does not tell a complete picture.
The artificially high interest rates, you don't need to go in to look at this slide, but basically you've seen the Fed raise their rates. And then there's another risk premium that when the lenders feel comfortable, they lower. When they don't feel comfortable, they raise. So you're paying 2 sets of situations that are artificially inflating interest rates now. So once that I guess the consumer index starts to slow down and inflation slows down to the point where they feel comfortable, they'll start pulling some of those artificial things out of there. And we should try and get back to a normalized, balanced, kind of marketplace.
Right. And then here is, if you're looking at the slide, this is a pretty detailed matrix of going through about 8 different strategies on here. We won't read every single one, but you guys can download it. And then we just labeled them like red light, yellow light, green light for, what's easier being green, what's a little bit harder being yellow, and what's the hardest right now being red. And these are just, hey, what are different strategies that work really well in the marketplace right now? And the 2 best ones up there right now are long-term rentals and house hacks, right, guys?
Yeah.
Yeah. And then the other ones, medium-term rental, short-term rental, room by room, BRRRR, wholesale flipping, all their strategies, they're great strategies, harder to execute right now. And where we're putting a lot of energy into education and also helping our clients go is really into those 2, the long-term rentals and house hacking. Why? Well, because they are proven long-term wealth building strategies. Like they're very simple, they're very straightforward, they make a lot of people rich. But also more importantly, like, hey, we can't change the market. Like I said earlier, Steve, we kind of take what we're given. Mm-hmm. And we say, hey, we've analyzed all the data. You guys walk properties. You own up there. You invest up there. You talk to clients. And you say, hey, here's where we're finding the sweet spot. And those 2 are the long-term rentals and house hacks. So now we're going to shift into actually going through 3 deal analyses. The first being new construction. The second being a 1-year case study on a house hack. And the third is going to be a house hack fourplex. So 3 great strategies that all work in the marketplace. So Steve, I know this first one is a new construction one. It's a great equity deal. Walk us through it.
Yeah, this one's pretty straightforward, and it's allowing us to kind of see what some of the builders are doing. So you have small builders, medium-sized builders, and large builders. They all approach things differently. Big builders have contracts with lenders. Medium-sized ones don't necessarily, small ones don't. So there's some other things that can happen. But what they're trying to do is offset some of the cost of increased interest rates and the cost of getting loans. So what is happening in some of these is they are offering up discounts, and then they're offering up concessions to help offset the cost of loans. So in this particular one, we have to know which ones, because you can find some of these out on the MLS, but they don't put all of the information out there because they're not as sometimes capable of knowing how to put it all into the MLS and some of that to be able to explain it correctly. So we're seeing some of those. We talk to the builders. We know what they kind of have as trying to finish off one of their developments. And so this is one of them. It's in a really good model up there that people would really like to use for rentals and for house hacking. And so it was on sale for $63,000 below. So if you bought one that had a month out to be able to be ready for completion, you'd pay the rack rate, you'd pay the list rate. But since this one, for whatever reason, just didn't get picked up, it's got a deal sign on it. And that's what we understand because we watch and, I have a couple of these. So I actually really like this particular model.
Like you own yourself, you're saying. Yeah.
Yep.
And so this is one of the great things about new construction that, I have definitely learned as I've been an investor out here is like, you don't think new construction and networking in the same sentence, but really for finding deals like this, it really is key networking because I've seen for last number of years, minus, a year or so in COVID, the low interest rates, end of the quarter, builders would say, hey, I've got a couple couple houses I need to sell before the end of the quarter so they can hit their numbers for whatever loan or, goals they have. And like, hey, do you have any investors or buyers that want something for $50,000 off? Yeah. It's like, well, yes, sir. Thank you for calling me. I appreciate it.
I get those calls a lot. Actually.
Yeah, do you?
Yeah, there's a couple builders where we both work very closely with their seller reps. And when they have something that they're just trying to unload or finish out the phase so that they can move on, they'll reach out. Hey, you got any buyers for me? Yeah. I love it.
Yeah. And so definitely make sure if you guys are wanting to know that, you plug in with Steve and Newt, and also either go to the website or send us an email. We'll add you to our email list, or I should say our deals email list with Envision Advisors. We usually send out like 1 to 3 deals a week between Pueblo and now Northern Colorado. House hack, multis, fixer-uppers, just kind of what we see out there. Yeah. Some new construction as well. So definitely reach out if you're interested in properties like that, because when they happen, they get scooped up pretty quick. And, hey, just like the builders call you guys for go-to, if we know investors want it, guess who gets the first phone calls?
Yeah,
people that we've talked to.
I actually have a duplex under contract that we actually floated up from backup offer, and it was in Fort Collins.
When you say floated up, what do you mean?
Well, we were in the backup position, and for whatever reason, the first position bowed out, so we got to get up in there. But basically, my point is that to your point, that everything does go super fast. We put that offer in a day, the day that it was on the market, and we still got backup position. So being able, and that particular client's actually house hacking a duplex. So it's,
ooh, that'll be a good podcast one day.
Yeah.
Cool.
Yeah, that's a great one, because I've heard you talk about it before. So back to this one, just real quickly. It's in Severance, which is one of those small little towns that is in and around on the east side of 25. And the retail list price that you would have bought it normally is $502,000. So there's a set of options when you buy new. You get a list price, and then you go in and pay for options too. So that always raises
like appliances and put grass in the backyard,
fence, things like that you want in there. So basically, it's about $63,000 off. Getting that equity day one, being in an up and coming community in an area, and then being able to refi it potentially, and sometime in the future you can, then actually make it work hard for you. So
that's like what, an 8% discount essentially off normal price, right?
Yeah.
That's the thing. Like that is that's a great deal.
Yeah, it's a great deal. That's why if I wasn't selling the property out in California right now, where I've got some stuff tied up in, that would have been one that I just said, I think I'll take this one for myself.
Yeah. No, and this is like, talk about the new construction as well, because one of the things about new construction is like it is relatively turnkey in terms of maintenance and issues, right?
Yeah. What I like about the new construction is you have a year warranty with the builder. And so anything that's not fixed on the way in, right before close, because you have an inspection right before. And so it's usually kind of chaotic because a lot of stuff still isn't done. You can have a window missing and all kinds of stuff like that, because they're getting it done and they're trying to meet a timeline. But once you get in, if it's not done by that day, at least the builders up in Northern Colorado have been pretty good about saying, okay, well, let's put it on our warranty list. And so you do one within a month, and then you have, a light inspection that we do at about 11 months. And they kind of say, what are the things we saw in the first time? And then are any new things popping up? And then you put that back into the builder. So you kind of have a break-in period of the first year. If you're a house hacker, if you're just a landlord, there's a little coordination you need to do with, like, I use a property manager. So the property manager and the subs, I give them the renter's information, and then they'll coordinate getting some of the stuff completed.
Do you have a good PM for Longmont?
I'll have to see if mine goes down.
Okay. I got a client that's having a hard time finding a good PM up there. Okay. And I just realized I should probably talk to you guys.
All County Properties has always been pretty reliable.
I'll get with you guys, do some intros off of there. Thank you. That was on my note to talk about, so I'll do it in the webinar.
Look at that. We got it right there. Okay. So this is a lot of information, so I'm not going to wear you guys out with this, but basically you get the purchase price on the right there at $439, and you'll see that it's got a negative cash flow, but that's under a property manager. So if you were to property manage yourself, you might be able to take off $270. You also look at maintenance. You have less maintenance in the first few years. So that's putting money in a bank. It's setting aside, because you're going to need it sometime down the road. But both of those things, if you took those out, you'd be pretty close to basically cash flow neutral if you wanted to manage yourself.
And this is assuming a 25% down payment?
Yes, this is assuming a 25% down.
Yeah, okay.
So it's still pretty good right there. But, if you want it property managed, if you can refinance it in a couple of years, those things will start helping your cash flow.
Okay. We have a question, Newt, from Matt. It says, Newt, is the All County Properties the one you referred to me before?
Yes.
I don't know Matt's last name.
More than likely.
Okay. Most likely, Matt.
I work well with Carrie out of their Fort Collins office. They do a lot. And I believe they go down to Longmont and Fort Collins, Loveland, Berthoud, and Greeley.
Okay. Fantastic.
So, and what's, just to go back to that for just one half second, is what's great about Property Llama is it allows me to put in a bunch of different variables, because you'll notice that I put maintenance down pretty low. I put appreciation a little bit higher at 4. And then I put property management 10%. So you can adjust those to kind of see, like, if you don't agree with my, assumptions, change them, make them yourself, and either make it work harder for you or, different for you.
Yeah, and that's a great thing to highlight. It's all about, there's so many different levers you can pull on here. And, we always try to do, fairly, I say, proper and more conservative underwriting, rather than saying, oh, hey, this thing is, hey, it's amazing cash flow right now. Well, amazing cash flow right now in the market is just really, really tough. But this is why, you're looking for, hey, new construction deals with equity upside. Hey, that's a really good opportunity in the current marketplace, but you're not going to get rich off day one cash flow.
Right. You've got that long-term mindset.
Wow. And as another note here, we got these are screenshots of Property Llama up here. So this is a software we've built and we use to do a lot of like modeling and more portfolio optimization. So if you guys have any properties you want to plug in there, reach out to me or Newt or Steve and we'll get you plugged in and get you set up. But back to here, we're looking at about a 4.5 cap rate and about a slightly negative cash flow, as you said.
Yeah, and I noticed that when I did it in Property Llama, I didn't change it, but because the cap rate is on the purchase price and not the ARV, it actually is over 5% cap rate if you use the ARV, not the purchase price.
Oh, nice.
So that's what the equity does. So so year one, you're going to see about a $22,000 return if you look at the 4 quadrants of real estate wealth building. And that's with a negative cash flow. So you need to feed that beast for a little bit until you can go back in and refinance it. And so you're going to be able to have that. And then if you could refinance it after kind of 12 to 24 months, the ROE is going to start kicking right back up because you want that higher ROE. You bought equity going in so that it actually makes the ROE a little bit more strained in year one. But then when you take the strain off by not having artificially high interest rates, it get back to what it should be able to do. And that's more of like that 16, 17% ROE.
That's where we like to see them.
Yeah.
Fantastic. Well, great job on sharing this. So thank you. And as another note on here, we're going to be doing a lot more deal analyses in Northern Colorado. We're currently building out a new section on the Denver Investment Real Estate website to host the trends, the updates, and start adding a couple deal analyses a month that you guys either see or close, with yourself or clients. So make sure you plug into there if you guys want to stay up to date on the Northern Colorado deals. All right, let's talk about this one. This is the second deal. And I know you're very close to this one, Steve.
Yeah. So, the flip side of getting the deal on it is to take a look at one under kind of normal circumstances and seeing some of the appreciation there. So it's a little bit different, but it's actually the same model that we just got through talking about, but it was purchased a year ago in May. And what the cool thing about it is we just paid list price for it. So the list price on it is like buying an iPhone or something like that. You don't go in there and negotiate. You just say, you know what, I'd love to have it. I'll do it.
Good analogy. Yes.
And so that's where the builder was at that point. And so buying that property, living it for a year, and then having them move out, well, that is an easy way to be able to kind of get in and get that done. So, and it's right on the MLS. But the networking, again, does help because when they're getting ready to launch these, having relationships with the builders and knowing when they're going to come out with it, you can be ready before most people can be ready. So it's kind of like, an opportunity because you're behind the curtain, not on the other side of the situation. So it's 2.5 baths. You look at the list price there, and when I say list price, that's really what the base price was plus options, and so you get an out the door price of
about $492.
Yep, so about $492. So that's like the one from the year later that just sold, but it's in a slightly more desirable area. So it's new construction. It's a high demand community, so it actually commands higher rent rates than some of the surrounding communities. So go ahead and move to the next one there. Finding it is just, I was able to watch the phases as they're coming in, and I knew which one I wanted. I knew which model I wanted. I knew all those things, so I was able to tap that in right away. And so that's what we can do. So, and the great thing was we went and got the appraisal done on it. And so sometimes on new builds, you don't get full appraisal because you're adding in certain things like the options, and it can struggle. This actually came back as an evaluation of $29,000 over what we paid for it. So now, is that fluctuating with kind of the market right now? Sure. But will it be long term? No. So this is where you can see some of these. I put in a slightly higher appreciation rate. Sorry, easy for me to say. At 5% because of this development's style. The other one was 4%. So when you look at those, you see about a 466 negative cash flow. Well, that's because it's got maintenance and property management in it. And so those two things, again, get you a little bit closer if you were going to self-manage it. But I prefer not to do that. It's that way. And then,
and that could be made up too when your son moves out and renting that extra room. So that could be made up as far as the bringing in, offsetting against the
there's
property
a few
management.
Different things. Yeah, there's a few different things. If he was going to stay in it and house hack, but we actually took and put it up and rented it. So that was the goal, is to kind of get it fully out. And basically, I did the analysis and the underwriting at about $200 less than we actually got for it. I was actually pleasantly surprised. I was not wanting to disagree with my property manager, but I said, "Are we sure this is it?" He said, "Yeah." And so we got it, and it's like $200 more than what I was forecasting.
So rents, we get $28.95.
Yep.
Wow.
Yeah.
Okay, that's solid rent.
Yeah. So that's a solid rent.
And then plus they pay utilities.
Yeah, they pay all their utilities. So in that other income, you'll see there's actually, we bill back for trash. We bill back for non-potable water. So they pay for those, and it's a pet.
Okay.
So a little pet rent doesn't hurt. And with the escalation, it's tough to see over time, but you see that ROE because it costs a little to get in. It's like $28,000 to be all in to get in to secure a $500,000 property that will grow. So that leverage is really key. That's what gives us the 48% ROE because it's so little. It's not 25% down, it's 5.
Yeah.
So right now we're very pleased with the way it's going. And when I talk to people about negative cash flow, they generally go, "Oh my God, I can't believe, why would you even think that?" But when you start to look at all the numbers and say, how long can I feed that beast? Because in 4 more years, the PMI drops off. That's $170 a month. And then your interest or your appreciation on rents should be up to a point where it should roughly cash flow. And if you're taking a number and say, well, I've got $125,000 I could put in, is it better to put in $25,000 and save the $100,000 for other things, and get a higher ROE? That's what my philosophy is. So I'm okay, because of the reserves and the way I do things now, paying a little bit of negative cash flow to be able to lock that property up.
Yeah, I agree. I think anytime you can put down like a crazy low amount like that, obviously you don't want to be bleeding, but a couple bucks here or there, man, in the long run, you make a lot of money by being highly leveraged.
Yeah.
Assuming rents go up and prices go up, which
they are speculative.
It should, it looks like it should keep going up in northern Colorado, as in with most markets around Colorado. So with, I know as a side note here, we are going to be doing a different webinar or podcast sometime this year on the strategy that you've done with your son to help him house hack, which I know has been a very powerful wealth building, partnership for you, your wife, your son.
Mm-hmm.
So we'll go into details on that. If anyone out there is interested in how Steve structured that, definitely reach out to him, email him, or give him a call. And I know you're more than happy to walk him through it.
Yep.
But we'll have an official podcast out sometime in the near future on that. But it's a really cool strategy. All right, here's our third deal and our last deal for this webinar. And you got 2 great things. You got a house hack and a fourplex. So this is a house hack fourplex in Greeley, right?
Yeah. Newt's been eyeballing this one here. So.
Yeah, there's actually several of them in the age. A lot of multifamily that we're seeing. But my idea on something like this was, if some folks had their college age kid that's going to Greeley, UNC, or even Ames Community College up there is very popular. If they were to take and invest in something like this where their child gets to stay at the place, I mean, it just makes sense. And there's, some investment tools to be able to help them finance that kind of thing. But the house hack portion, making the lower down payment, is going to make it a little bit more affordable. And then again, relying on the appreciation and everything, plus the rents, should help, offset any of that negative.
Greeley has some interesting older areas that are kind of like in the downtown. And so Newt can probably speak to it better than I can, but there's some great turn of the century houses that have like 7 or 8 bedrooms, 4 or 5 bathrooms. They're just really, amazing structures that were put there. And these are what sometimes, instead of the traditional fourplex where it's kind of a rectangular one with a, 2/2, it's actually, there's other ways to get into the house. They can split it. So there's some pretty creative ways.
Oh, that's
people can
true.
do that.
Yeah. And a lot of them
Greeley is
are
one of the few places that has that.
well, and a lot of the zoning as well is high density. So there's areas that, like, I know of a couple of houses I've seen that actually had 7 bedrooms. So not only can you rent that, but the lots are huge. So you can build an ADU on the back end of it.
When you have parking for all these people. So there's some pretty interesting stuff if you're willing to think creatively and see how you can do that. If somebody was going to come in and with their college son or daughter, take that place on, they can go in and get a 5% down. Or they can go in at a 25% down. It depends upon how they want to approach it.
Mm-hmm.
So.
And then walk us through the numbers on here, because it just seems like a great deal.
Okay. Well, Steve's usually the numbers guy as far as walking us through the slides, but this particular property, it's been on there for about 3 months, I think we said.
Yeah, it's close to 90
and
days.
so, for whatever reason, it hasn't sold. And I have seen that there's some
Must be
deferred
overpriced
maintenance.
then, right?
Well, yeah, price fixes everything.
Yes.
But the purchase price that we've got in here is at $475, just assuming that we could get, whittle that down with our investor client on our side that we're trying to do, or trying to get them into it.
And so one thing I want to talk about, because you had mentioned this, Steve, I seen the slide here. You said there was a lot of like older homes in downtown Greeley, and I've been in Greeley just passing through. I don't know the market like you guys do. The older homes, is it the spectrum? Because they're, hey, cool, it's 7 bedrooms, but it's also a 100-year-old house.
They are 100 years old.
And so we're talking
Occasionally.
new construction, we're talking old. How is the old construction? Because I've been in some old homes in Denver, the 1890s, 1900s place. I'm like, wow, I would never want to own one of those places. I also don't like deferred maintenance on anything.
Right.
So or is it just across the spectrum as far as like condition and layout? Or is that like a major hurdle, do you think?
I think it's one of those, and Newt speaks to it better than I do, but I'll just say that there's probably less appreciation and more chance for cash flow in these. So when we did the underwriting on this, we went, about as high as we wanted on the maintenance, because there's going to be more of that. But because and they're probably going to get a little less appreciation because of the areas in, and so it is a 100-year-old house.
Okay, so a bit more of a cash flow play versus appreciation play.
Cash flow plays still left, and that's where there's some of them there. So it's creative. So if they've got 4 units in there and they all rent at different rates, the person that's house hacking can take the smallest one and manage it, so they don't need property management.
Yeah.
So Newt, you have some other probably anecdotes on some of the.
Yeah, I've sold actually many property. They're all over the map though. There's some that were built in the 20s. There's some that were built in the, 60s. So it's kind of, it's sporadic as far as the types of homes. I've seen a lot of them, excuse me, a lot of them, like they will have sometime in the past, they'll have added exterior entrances to a basement for a house that was just a top and bottom.
Oh yeah.
So they've gotten really creative with making those separate domiciles, but that goes to the rental aspect.
Well, and when you look at where that one's at, it's right between the medical complex and the college. So it's kind of got, either or, so it could be, some version of each that would be an opportunity.
Yeah, that's one thing I like about Greeley a lot is just, the university. That's such, a magnet, and, there's A lot of wealth is created around universities and hospitals. Very hard for them to move or go out of business.
When is UNC, I wouldn't think it's much of a commuter school. It's probably people
No, there's,
that
I mean,
live in Greeley and go to school.
put
in
a
Greeley, 'cause you don't
major
really-
investment in their student housing up there.
So look at these numbers on here. I mean,
So Steve was conservative with the appreciation on this, which is probably a good thing.
Well, and that's what we
Greeley-
talk about. Like, I don't want to oversell something because it's like, okay, but even if it just
undersell
does
over or undersell over promise.
Underpromise,
Maybe we'll
overdeliver.
reverse that, huh?
But when you look at it, if it was managed by the person who's living there, you don't have that. There's no HOA fees. There's no metro taxes there. So some of those things aren't there, and they can at that rate. And we did the underwriting as if all 4 units were filled, because if they lived in it for a couple of years and then moved out, then this is what the property could yield. Then what the value of it to the person living in it is take the lowest cost one in there
Mm-hmm.
and then reduce that. And that's what it costs to live in there. And I think when we looked at it, it would be $250 a month for the individual to live in there and manage it. So they have a home to go to school from as a point, and then they have 3 other people renting that are offsetting, 90% of their cost.
Oh, that's great. I love those types of plays. And then longer term, so these sound like it could be great for just a straight long, like a landlord investor. Hey, let me buy a property, get exposure to Northern Colorado, have good cash flow, have high demand. So that's one play for long-term college rental, or doing a house hack turn to rental, right? Those are kind of the two best things you see for this type of property. And in
Well, and
downtown
that's where
Greeley,
a lot of people, kind of get the notion that they want to get into a duplex, a duplex, or a fourplex. And this gives them the opportunity because there's not as many available. I think there was 44, I think on 2 to 4 units between Larimer and
in the whole MLS, I believe. Yeah.
yeah. So there are some out there, but this is a really good one to as an example. Now you may get in deep into the inspection and find some things. Maybe that makes it cheaper, and then you pay for it through that. But they're worth exploring because there's opportunities there for the right investors. So everybody does it differently.
All right, so those wraps up the deal analyses, and then we got the last part of the webinar here is just going through a couple of frequently asked questions as well, for questions that we get a lot for clients up there, and also just some market nuances as well. So Steve, walk us through these.
Well, just quickly, we kind of talked about cash flow versus appreciation. I have I run into a lot of people that still is cash flow is kind of like their first thought when they get to investing.
Yep.
And so it's getting people's thoughts to be more balanced about the 4 quadrants of wealth building and real estate. And then they get a balance. But there are some places where you can still get cash flow. That's what that last example. There are some things, if your situation's right and you can do it right, that wouldn't be for me, and my wife to go do something like that. But there's situations where that might work out great. So there are both. And as far as housing prices, we're seeing those, across the country right now. They're kind of at about where they were at historical highs. They're not dipping like they were. And when this artificial stuff stops and we see all the momentum behind jobs, population growth, and, all of that going on in Northern Colorado, I believe that they're going to kind of reignite some of that growth. And then rents have been pushed higher right now because people can't get out and buy their own homes because they're locked out by the interest rate. So they're forced into renter status, and there's more competition for homes. We have a couple 4 bedrooms that 2 people live in them. They didn't bring in a whole family. It's a couple. So they've got
2 people and probably 2 home offices, right?
Possibly.
Yeah.
I know one is that way. And so, but so not every time is a family of 5 coming into a place. It can be, a lot of different ones. So I think that the rent appreciation, that's why, like I say, we underwrote the one in our neighborhood and it came in 200 and change more. So it was like, wow.
Do you know kind of what the historical rent growth is there by chance?
Historical is a little tougher, but
Or current
the
rent
last
growth?
year's probably for single families probably been around 6%. I was
Oh
talking
wow,
with
so
my
that's stayed
property
very
manager.
strong as well.
Yeah. So, and I looked at some of the ones we have, and that's some we actually did a turn, so we were up 12% because we were able to get it back to market. But the apartments and the townhomes and condos, they compete differently. So when you have a 3-bedroom or 4-bedroom, that's not really something you find in apartments, right? A 3-bedroom's pretty rare in an apartment. So when you got a 4-bedroom, you're not really competing against them. But when you start to get to 2 bedrooms in a townhouse or a condo, you're starting to compete with 2-bedroom apartments. And so that holds it down a little bit. So I've heard numbers more like 2% appreciation on rents in those.
Okay.
So it's kind of a ceiling that's holding those back a little bit. So not that they're still not good. It's just go in eyes wide open and kind of see where that's at.
Makes sense. What about just rules and regulations to be aware of?
It's interesting. And Newt and I talk about this all the time. You've got these 2 counties that butt up next to each other. You've got Larimer on one side and Weld on the other. And then each city has their own little set of politics. But on the whole, Larimer has more restrictive, it's kind of been an older, more established area. And Weld is kind of that, less regulation, less cumbersome things. And so that's why you're seeing some of the rapid growth in Weld that Larimer is going to get caught and passed at some point here in the next 5 years, because I think the population was 360 and 366. So Larimer is not growing near as fast as Weld, but together they're both really growing. So, you've got more short-term rental regulations in Larimer and some of the places there. Weld is like, do what you want. And so there's a lot of value to that. And so depending upon who you are as an investor, you may want to choose one of those over the other because it either secures you or it frees you. And it depends upon your investing strategy.
Are you, kind of now or last couple of years, as I hear like rules and regulations, my mind always goes towards short-term rentals and Airbnbs. And I don't know that market up there. I mean, I don't know Airbnbs very well at all. I know, the high level here in Denver, and Denver is very hard to, do Airbnb in. Do you know about the Airbnb or short-term rental laws up there, or is that even a popular investing strategy up there?
Newt, on the Larimer side, I mean,
I would
you've
say
heard some.
Well, Fort Collins is probably the more restrictive of everything else up there. And I, as far as like Greeley, it's not as restrictive, of course, being in Weld County, but also it's further away from, say, the mountains. You got a half an hour drive to the mountain or to go up to Estes Park or wherever you're going to go. So it's not as a convenient location. But as far as the Loveland, Berthoud, that's actually a really good question. I'm kind of
the
thinking about that.
I'd looked at some of those probably a year and a half to 2 years ago during the height of it. And with a lot of these new developments, they have HOAs that don't allow
covenants.
Yeah. So basically nothing less than, I think the one I live in now, I think it's less than 6 months. It's not allowed.
So most of the new build communities probably don't allow it, I would imagine.
So that really takes a lot of the places off the board. And so where there is no regulation, so like if you say the town of Windsor, Severance, some of those Timnath, or maybe even Berthoud, they might not, but they have to have something, like Newt says, a reason to get there. So it may be that you want to go in and be in a certain area and you either have a hotel or an Airbnb, but you can't stay. If you're coming in to visit family, sometimes you get Airbnb, sometimes you get a hotel.
Yeah.
This limits you staying, either stay with your family in a place where no short term is available, or you have to go someplace that's a short distance away. So I think where the opportunity is, it's still a little bit where we're at, but it's probably more towards the mountains where they've had some pullbacks here and there. I think Estes has been looking at some different things when they talked about, kind of pulling back because they're worried about workforce housing. They're worried about that. So they tend to overreact. And
even in the city of Estes, also the county steps in if it's outside of the city limits on Estes Park as far as some of the short-term rental regulations. But I would actually, any of our investors that are watching today, I'd be really interested to talk to some of them that are actually doing the short-term rental stuff. I'm fairly new to that aspect of the investing, but I from what I understand, it's gotten pretty saturated, and I would actually like to know kind of where that sits as far as their investment strategy and how it's playing out.
Cool.
So have them give me a call.
Very good. All right. What else? What other FAQs do we have here, Mr. Medina?
I think the only other ones we've talked about a little bit is the good versus evil, and that's metro districts. And so they're a polarizing thing, and so some people love them and some people tolerate them. Now,
first, what is a metro district? A lot of people do not know what that is.
That's a good point. So it's kind of a quasi governmental body that is the underpinning of a new development. And so what they do is they create all the infrastructure in a new development. So it's the streets, it's the sewers, it's the water, it's the electrical, all those things. And rather than saying, okay, we're just going to add this into a price into the home up front, they do it through a bond process where they can go out and they say, everybody that's going to be in this neighborhood is going to help buy the bonds that we're going to use to pay this, and then we're going to pay them off over time. Now, they're a big play in the difference making between Weld County and Larimer. I can, show people the difference in new construction and how fast it's growing versus like Larimer, where it's slower growing because they're anti-metro districts. It's one of those fascinating things that time will tell.
But I mean, the new build rentals that you own, are they in metro districts,
Yep.
Steve? Okay.
Yeah, most of them.
Most of them. Okay. I mean, so like I know, like I said, there's a whole spectrum of them. But I always like to say, hey, you've researched it. The fact that you're putting your money there, obviously, like not a huge concern to you, I would say, because otherwise you want to put a bunch of money into it.
I don't see it as being a huge impediment because I'm trying to figure out, like, what am I paying for? What am I paying and what am I getting? And so, some of the things that are in some of these developments are like lakes or golf course or, other facilities. And so there's a lot of benefits to that. Some of them are maybe not worth it for the people that move in there, but for where I've seen, they can be really good. But I'd love to make sure that they still have more oversight over time, because in theory, you should be able to pay them off someday. But since they're still so new, you don't see 20 years, 25 years down the road, you should be able to pay off those.
Well, I think to give you guys a little more context, I think Highlands Ranch is probably the most well-known metro tax, in at least the Denver area. Yeah. I mean, I live there, and I think, they're a great, role models, not the word, I guess, case study for metro tax districts, but they've worked extremely well. Like I said, not good or bad, but if you are buying a place, make sure you check to see if it's in the metro tax. And if you do, go in there and do due diligence on the metro tax, because I've heard some horror stories.
Yep.
We've been under contract with some in like the Denver metro area. And once we've done our due diligence, or say our clients on their diligence, we've peeled back there. We're like, oh yeah, that's actually, you got like one of the rotten apples there, and we've terminated. So always make sure you understand what it is. Yep. But of course, please do your due diligence.
Yeah, that's a great point, because there are some ones that have actually caused legislation.
Oh, yeah.
So there's more oversight in that now. So, and
the Denver Post did some good articles on, I think, a year ago or maybe 2 years ago on there as well. Like, yeah, there's, like I said, not good or not evil. I love that phrase you used. Awesome. Well, any other things we're going to wrap up here with as we kind of come up on the top of the hour? Cool. So as a quick reminder here, and I see a couple questions coming in here. If you guys have any questions, please reach out to Steve or Newt. And actually, probably Steve will be your best point of contact. Steve does a lot of like the strategy building, portfolio optimization. Newt's more the executioning. You're executing on the, man, I botched that one, huh? You're executing and the deal's done, and you're a great negotiator. Or if you're really bad, he will execute
That's
you
right.
too, right?
Pretty good.
No. But please reach out to us. We do like to do those free investor strategy consult meetings. We're very much about relationship building, consultative sales, whether you're a brand new person, looking to buy your first place with house hacking and scraping together pennies. We've all been there, done that. Yeah. So we're happy to help other people in that situation. Or if you get a bunch of properties, we'll do a portfolio analysis with you as well. So I see a couple comments in here saying, thanks for the seminar. As a beginner investor, very helpful. Awesome. Glad to hear that as well. Another question. Okay, if you guys were to buy one property right now, or kind of like one strategy in one area, where would it be? You first, Steve. His gears are turning on here.
Well, that's.
I love it. Put some thought into it.
It would have been 2
that
weeks
new construction?
ago, and that new construction one. That would have been the one, and so I would have picked that up.
All right. I love to hear that. So yeah, gut reaction. Newt.
I would probably go for a multifamily, probably in Greeley, because it's not likely to have a metro district. But also, I like to mitigate my risk with multiple units.
Yeah.
So for vacancies.
Cool. Awesome. Well, I appreciate that. I think it's perfect answers. All right, everyone out there watching and listening, we appreciate you coming out. I hope you found this extremely valuable. If you want more details, we're happy to send a slide deck to you, a lot more data. But also, again, reach out. We're always happy to have conversations, build relationships, and we want you to be educated to make the right decision. So do not hesitate to reach out to really Steve and Newt for information on Northern Colorado. Any help in general for Denver, Pueblo, or Colorado Springs, reach out to us. We got amazing team members up and down the whole Front Range now. And I'm very glad to have you two on board with Vision Advisors now.
Awesome.
So we're going to kick it off, guys.
Yeah.
Thanks a lot, everyone. We will be talking to you soon and sharing lots of new Northern Colorado data and deals with everyone.